Welcome to the Phoenix Prosperity Podcast, where wealth meets legacy. Join your host, Tim Fergestad, as we explore the journeys of Phoenix's finest to success and beyond.
Hello, this is Tim Fergestad. Thank you for joining us. I'm very pleased to have Joel Friedland with me here today. Joel is the CEO of Brit Properties, syndicates debt-free industrial real estate in the Chicagoland area mostly, I believe, but he has some strong ties to Phoenix too, so I'm excited to hear all about it. Welcome to the show, Joel.
Thanks, Tim. Great to see you.
All right, so why don't we talk a little bit about how you got into industrial and when that was?
Yeah, I'm 66. So in 1981, when I was just out of college, I went to Michigan. I came out of school and I went to work for a family in the industrial real estate syndication business.
Okay.
And I didn't know them. I cold called them. And I actually was given their name by someone who said, "Hey, I think they're looking to hire a broker or a property manager." So I called up this fellow named Milton Podolsky. And he invited me in the same day that I called him. And he said, he interviewed me at his conference room table in his office. And he said, "Young man, I'm going to ask you one question and the answer will determine whether I hire you or not."
Nice.
I said, "What's that?" He says, "Do you know how to take no for an answer?" So I had to think about that.
Yeah.
And the honest answer was, no, I don't take no for an answer. It's probably one of my best and worst qualities. My wife will tell you it's my worst quality. And my investors will tell you that it's my best quality, because that's how we get tenants. So I went to work for Milt as a property manager and as a leasing agent. And he and his two sons and his daughter taught me the industrial real estate business from their standpoint as owners with a group of about 100 investors of 80 something buildings. And in 1981, interest rates were 17%. Businesses were struggling. Real estate was struggling. And they had 10 vacancies in their 84 properties. And my job was to go to industrial parks and not take no for an answer, to make cold calls inside of the buildings where I'd walk in unannounced, ask for the owner of the company, and then quickly say to them, "I'm a leasing agent for a building down the street that's vacant, and I'd like you to move there. Will you consider moving out of this dump?" Which I never should have said. That was a bad thing to say. One time, I walked in. I was in a town called Alsip, Illinois, south suburb of Chicago. And I walked in, and there were these two guys behind a counter. And I just kiddingly said, "I've got a building down the street. Would you like to move out of this dump?" And one of the guys looked at me and he said, "Dump?" And I said, I was kidding. I was just, "Dump?" I said, "No, it's not a dump. I just was kidding. Like, would you like to move to my building?" He said, "Just a minute." And he went behind a door. He went through a door and he disappeared for about 30 seconds. And in a wheelchair, out comes this older man. He said, "This is my dad and he owns this dump." And the father said, "You think my building's a dump?" I said, No, I was just kidding. That was just the thing I was saying." He said, "Boys, throw him out." So one son took me under this arm and one son took me under this arm, and they carried me out of the front door of their warehouse and they dropped me on the sidewalk. I ripped the knee of my pants and was bleeding. That's the last time I ever said, "Do you want to move out of this dump?"
Funny. Yeah. Okay, that's a good one.
So they taught me how to be a syndicator, and I became one. And I have assembled about 250 investors. One of the reasons I'm intrigued about your Phoenix point of view is because I have many investors in my group who either winter in Phoenix or who make a home in Phoenix. So I end up going there to have lunches and dinners and golf with my Phoenix investors. And I'm so lucky to have them there, because living in Chicago, as you know, having been from Minnesota, it's so cold here. It's great to go in the winter and spend some time with people I like.
Heck yeah. That's it's a nice way to do it, is the snowbird. It's a neat thing I think coming from the Midwest to living in Phoenix is there are so many other transplants from the Midwest, and
Yeah.
um, the football games are the most obvious, right? When the Cardinals host the Bears or the Packers or the Vikings, it feels like a home game for the visiting team, and to the point where they have a campaign called "Protect the Nest," where they try to really make sure the local crowd shows up. Otherwise, yeah, it's funny.
I
Anyway,
have other connections to Phoenix. It's interesting when the the brother-in-law, my wife's brother and his wife decided that they wanted to be somewhere warm in the winter, they decided to build a house in Paradise Valley.
right.
Uh, and the Diamondbacks, I have a connection to them. My cousin was the bench coach the year they won the World Series back in, I don't know, must have been the early 2000s.
Hmm.
And so he's now a professional manager. He's the manager of the San Francisco Giants.
Oh,
But he
cool.
just happened to be good friends with the manager of the Diamondbacks that year, who had him as the assistant manager. And so I feel very connected to Phoenix.
Okay.
Um, we almost bought some buildings there about 12 years ago. Ended up not doing it because we're very focused on our Chicago niche. We tried buying
Okay.
some buildings in Florida, New York, Ohio, and it's hard to manage industrial buildings for me from
Remotely.
a distance. I don't like to get on an airplane to manage. I like to be able to drive in the car. It's hard
Right.
enough in Chicago traffic. Today, I drove down to two buildings in the city that we have,
Hmm.
and it was an hour and a half to get there from my home. And then this afternoon, it was 3 hours to get back.
Ouch.
I called my wife. I said, "We're selling these buildings."
Right? That's funny. Do you
Yeah,
wish you had bought those Arizona buildings 12 years ago?
I'm mixed. I would love to own buildings in Arizona. They've gone up in value. I have a good friend and an investor who works at JLL in
Okay.
Phoenix.
Okay.
He does industrial, and I've talked to him, and he says, "Man, you missed the boat. I moved here. It's the greatest decision I ever made." I said, "Yeah, well, my family's here in Chicago, and I've got this portfolio of buildings, so I'm pretty well set. I'm going to just have to travel in the winter if I want warm weather."
Right. I had
Yeah.
Kelly Royal on the show not too long ago. She's a VP at JLL here and does industrial in Phoenix.
I saw that episode. I watched it.
Oh, okay. Okay,
Yeah.
cool.
You talked a
Okay.
little bit about traffic there too.
Yep, yep. Okay, so I've not done as much real estate as you. I've not done industrial, but I have some of my properties, my personal ones, like my single family rentals and stuff. I would just buy outright, debt free, and I know you're a big fan of that. There are times though that like to apply some leverage and juice the returns, but of course there's a risk with that. Do you want to talk to us about your philosophy on that, Joel?
Yes. I've been through four down cycles since 1981.
Okay.
And I have discovered that my emotional well being is very much tied to when there's financial trouble. My mood goes down. I don't sleep well.
Sure.
And I made a decision about 7 years ago that I was going to find out if there were people in this world who believed that investing in syndications with no debt could work. I had to figure it out. I didn't know because nobody does it. It does. The returns are not juiced, and therefore
Right.
you're going to make a lower return.
Right.
And what I did was I put together my first all cash no debt deal, and I bought a building with a group of about 40 investors in Chicago on Tripp Avenue, which is the same street that Walt Disney was born on, but this is in the industrial section of Tripp Avenue. And
Okay.
it's a 33,000 foot building. We paid 2.4 million for it. And I raised 2.4 million plus an extra $300,000 in cash reserves because I am really risk averse.
Okay.
So I raised 2.7 million, all cash, no debt. And it worked. Some of the people said, "Well, whoa, that's unusual. I guess it's okay. I'll go into it." Some said, that's a great idea. I've never heard of it. I didn't have anybody who said, I'm not going in because there's no debt. It was just the way I presented it, was that I believe that sleeping at night is really important, and there's a place for deals with no debt. And that place,
for sure.
yeah, that place is our place.
Okay. Okay. So it depends on the goals and the investors, obviously. I mean, I am willing to do riskier deals with my money, but I am very conservative when it comes to other people's money, my investors' money. I'm incredibly cautious as well. I can't sleep well when there's problems on a property, right? Like that.
Yeah.
So I get you there for sure. In terms of returns, I mean, how many, so is this like a perpetuity model? I guess my concerns are, yes, everybody,
Yeah.
you go, okay, yeah, no debt, that sounds great. But then when they see the returns are a lot less than they could have got elsewhere, maybe, right? And then, but if you hold it long enough, you can start doing cash out refis, and there's other tax-free advantages and things with doing it. So can you speak to a little bit more about the overall return profile for those sorts of deals?
Yeah, I have a chart. If I could put up a slide, I would do it. But I have a chart that shows.
Yeah, sure. That'd be good.
Let me send it to you because it'll stop me. I don't have it handy, and I'm not good with my computer.
Oh,
But
all right.
but let me tell you what we came up with. We bought a property that gives off a 7% cash on cash return.
Okay.
So if someone went into the deal, let's say with $100,000,
Mm-hmm.
they would get
An annual
$7,000.
$7,000. Yep.
Right. And the rent goes up every year. The company that occupies the building is called Tampico. It's a juice company. They make fruit juice concentrate. And it's a really good company. They're part of a $4 billion conglomerate that's actually an employee-owned company that's called an ESOP.
Yep.
And it's a great company. It's a great tenant. They really don't ever want to move. They have a lot of equipment, and they have trained employees. And finding labor is really hard in today's world, especially trained labor that they can count on. And we did a study to determine what the annual average return would be on a 7-year hold with debt and without debt, using the same assumption that the property would sell for the same amount. So we did this chart. I wish I could do this, but I don't know how. But we did this chart which showed that if we sell the property for $20 million in 7 years, the returns to the investors, average annual, not IRR, but average annual returns, are 22% after costs and fees with debt. It's 19.5% with no debt.
Okay. So a few percentage points for, yeah,
it's for the safety. I feel like for the 2.5% extra return, is it worth it for me to be nervous and do? I'm not in favor of everybody doing all cash deals. I'm in favor of nobody doing them, because if I'm the only one doing them, then people who like it will invest with me. So I'm against anyone else doing it. But for me and for my group of investors and my GP partners, it's just something that after all these years we've decided to do. And it's an unusual approach. And we really do hold long term. I actually have a building from 1989. We did the deal in 1989. We have a tenant that I think has a Phoenix location. It's called Feed My Starving Children. And what they do is they pack food, right? Yeah, you've got one in Phoenix. We have 3 of them here in Chicago, and they're in our Aurora building. So it's a great tenant. They pay the rent on time. It's a nice 8% cash on cash return based on what we think the value is of the building, not the cost. The cost would make the return higher, but that's not fair because you can't compare it to anything. It's just a different approach. And some people think I'm really an idiot. Like, Joel, it's so hard to raise all that money and you're not juicing the returns with leverage. And I understand all that. In fact, I did something on my LinkedIn about debt-free. And someone just sent me something tonight saying, wouldn't it be great if you could just do 40% debt? Wouldn't it be better? You'd make better returns. And I'm trying to figure out how to respond to that LinkedIn post, because I don't want to sound inflexible, but I do have, sort of boundaries that I've set for my life and for
that seems like the values or the mission of the whole model is that, right? It's a spectrum. Yeah, could you have a little, or a lot? It's just a philosophy that I understand it. And I think you stick to your guns. You're like, that goes against our model.
Yeah. And I don't think we're losing any deals because we don't do debt. We're under contract to buy a building right now that's about $3.5 million. It's a lot of work to raise $3.5 million. It would be much easier if I could raise $1 million and borrow $2.5 million.
Right.
Because raising $1 million takes about 3 days if the numbers look good and if they trust my track record.
Right. Raising
$3.5 million is much, much harder, because if everybody puts in 50,000 for $3.5 million, I've got to have 70 people. That's a lot of investors.
Right. Let's double click on this too. Let's bash commercial lending for a little bit, right? Because not only are there costs associated with that you're avoiding, right? But that whole industry is designed around trading properties regularly, right? The terms on the loans available are generally not long term and not very conducive to a perpetuity model hold. Anyway, so yeah, do you want to add on to some of those points?
Yeah, there's a couple things. First of all, mostly they like to amortize. Most banks don't like to do interest only for very long. And if you amortize, you're paying off roughly 2% of the loan in your first year on a 20-year amortization schedule. So what that means is, if it was an all-cash deal and it was an 8% net operating income, NOI, your 8% on an all-cash deal is 8%. But when you borrow a lot of money at 8%, the bank is forcing you to pay down the loan. They don't want to have this set amount for the whole term of the loan, 5 or 7 years. So what it does is it brings the cash on cash return that the person who goes into it as an investor is getting really down to about 6.5. There's, especially today, there's this negative leverage because of rates being so high. I didn't even do debt when rates were at 3 and 4%. I still had the same philosophy. The problem with lenders is they have no sense of humor. And if you get in trouble, right? You get in trouble, they have something called a workout department. Unfortunately, when I borrowed money in the olden days and I had some deals that did get in trouble, nobody has a perfect track record. We've had 104 deals in my career, and we've had 9 losses. I'm not going to say we never lost money. We've lost money on deals. And when a deal gets in trouble and a lender feels insecure, there are 8 different ways that a lender can come after you with what's called the Laser Pro documents, which are the standard documents used by most banks.
Okay.
First of all, they want you to guarantee the loan. That's tough because a GP guaranteeing a loan is taking a tremendous amount of risk. But those 8 things, they can put you in default for lots of different
things, yes.
occurrences that have nothing to do with the building. If they feel that they're insecure about your financial position, if you read it, it says insecurity clause.
Yeah. Yeah. It's you can be hitting your debt service coverage ratio. You can be hitting all your metrics, but something happened in that market that isn't affecting how your property even operates. Something bad happened. They don't like it. They can feel insecure.
Yeah, they can put you in default. And what happens is they have a cross collateralization oftentimes, or they have something that's not cross collateralized where they say, if you are in default on another deal and they know about it, they can default you on that deal. And if you have 4 buildings at one bank and one of those deals is in trouble and the other 3 aren't, they can put the entire relationship into the workout department. And workout people are sons of bitches. They are, you know why they take those jobs? Because the jobs where they were working in prisons, like in the toughest prisons where they could be really tough with the prisoners, there weren't enough jobs. So they went into the workout department at banks. Same people. I had this lady, this Sharon was her name, at one of our banks. And we had 4 properties at that bank, and one deal was really in trouble. And they put all 4 deals into workout. We were in a default position because of the way the loan documents were written. And when the other loans matured during that time, they increased the rate. They made us pay down the loans with money we didn't have. We had to go get money to pay down the loan.
Cash in refi type thing.
Yeah. Yeah. And these are called forbearance agreements. Banks are tough because they're serious. They loan you the money. The loan documents are that thick for a reason. They protect the bank. They don't protect us.
Right.
And you go out and play golf with the banker when you borrow the money, and hey, let's have lunch and a great hole in one or whatever it is. But then when you're in trouble, that banker is gone. He's not your banker anymore. Now it's the workout people.
Right.
So I just don't want that complication. I just don't want those kinds of things weighing me down. And my partner's 20 years younger, and he doesn't want it weighing him down either.
Sure. That sort of experience sticks with you. I get it.
Yeah. And maybe it's just I got burned by touching the stove, and I shouldn't have touched the stove. Maybe the stove was too hot.
Well, sometimes you can tell somebody the stove's hot, but you kind of need to touch it to know for sure.
Yeah, you need to. So I'm a different kind of an animal in real estate, and it's odd, and it's something that a lot of people, when they hear it, they do a double take. What? You what? No debt? What? And it's just a way of doing things that's different. Right.
I've had it's definitely a bittersweet relationship with lenders. I mean, there's little to no accountability on their side as well, which is something that bothers me. We've had lenders bail on us like the day of closing or a couple days before closing, and keep our good faith deposits to pay their processing fees and everything and things like that. There's no accountability, right? Which they don't have to perform at all.
Yeah, a commitment letter is not really a commitment letter. It's a kind of commitment letter. It doesn't say kind of a commitment letter. But then when you read it, it's for a whole bunch of reasons they can change their minds, and it makes me feel insecure. Talk about an insecurity clause in a document. It makes me feel insecure to have that. But I do small deals. If I was doing $50 million deals instead of $3 or $4 million deals, I couldn't do this. This only is possible because I keep it small. We play small ball.
Okay.
I'd rather have 100 small buildings than 10 big ones, because I can handle each one at a time, raising the money for it.
Right.
We're an industrial, so a lot of industrial buildings have single tenants. When you do multifamily, you can borrow money with less risk, because it's not, if the tenant leaves, it's 100% vacant. If a tenant leaves, you can probably still cover your debt service.
Yeah, I learned that in single family, but yeah, that's one of the reasons why I like multifamily for sure.
Right, multifamily's got a lot of great attributes. Industrial's missing that attribute.
Well, there are. I'm seeing a little bit more of that where people they chop up a bigger building and have smaller tenants in different spots.
Multi-tenant industrial.
Yep.
Yeah, we have some of those. I don't like them. They're a management headache. Again, simplicity, all cash, one tenant. Tenant cuts the lawn. Tenant here plows the snow. Tenant pays for everything. If the heating unit breaks, the tenant pays for the heating unit. Sometimes we take the responsibility for the roof, because that's a very costly item.
Expensive, yeah.
Most tenants don't want to take that responsibility, but easier management is a big thing for us. And simplicity, I guess it's probably my age. I'm at the point in life where I just want to keep things simpler. And you're younger, right? You're able to take more risk, and you have optimism that isn't crushed by
I haven't been
by poor
crushed by
downturn.
life and turned into skeptical into a cynic. So,
Yeah,
Joel,
I'm a
in
cynic.
yeah, in terms of managing these properties, right? You have a team in your company. Can you talk a little bit about growing and the teams you've put together and how you're
Yeah,
managing
over the
that?
years, I built up a very sizable company up until 2014. We sold our company to Transwestern,
Okay.
and I went off after a couple of years of being at Transwestern and
They're
restarted.
global.
They're global.
Okay.
Yeah, it was hard to work for a global company after being the head of the whole thing as the CEO and
Sure.
founder.
Sure.
So
You're
um,
unemployable now.
exactly, yeah. So we've got a nice company. We've got 7 people. Um, there's a division of labor, accounting, property management, asset management, leasing, and I'm doing something really fun right now. I've got interns for the summer,
Nice.
and yeah, I've got these great young guys who are college students,
Okay.
and we started with 6. 3 of them have fallen off because it just wasn't a good fit. I'm
Sure.
a pretty tough boss, and 3 of them thought I was too tough of a boss. But 3 of them have been with us. So today we went into the city. We have a vacancy. We own a building where the Chicago professional soccer team, the Chicago Fire, has 7,000 feet, and the U.S. Postal Service.
They named the team the Fire.
Yeah, after
Oh
the Chicago
boy.
Fire.
Oh
It's
wow.
it's
Okay.
owned by the guy
Too
who
soon.
started Morningstar. And we have the U.S. Postal Service is in a warehouse next to them. And this is one of my
Okay.
multi-tenant buildings. There's 3 tenants. And upstairs, we have an office that's not part of either of the tenants. It's a separate unit.
Okay.
And it's hard to lease office space right now. So today, I along with 2 of the regular people who work with us, my partners, and 3 of the college age interns, the 6 of
Hmm.
us, went to the neighborhood where the building is located, and we went door to door like I did when I was 22. We taught
Okay.
the kids how to do it, and we went door to door and we divided up the whole area geographically and asked people. We brought brochures with us showing the building, and we asked people if they would consider moving, if they needed more space, less space, or if their lease was coming up. And after 2 hours this morning, we had 3 leads, 3 different companies that wanted to see it. It's amazing
Mhm.
how if you work, it works. It
Yep.
works if
Yep.
you work it. So
Absolutely.
I took them to lunch in Greektown, and we were having our Greek lunch, and I said,
Okay.
fellas, if you get a showing from your efforts, each one of you gets $100, no matter which one of you stopped in to make the cold call. And if you make a deal, it's not a commission, it's a bonus. If a deal is made with someone that you cold called, you'll each get $1,000. I said, so let's have lots of showings,
Right.
and let's make a deal and fill that space that is hard to fill by putting in some effort. And the guys ate it up. They were really great. And during lunch, we talked about the experiences we had in the morning. And they're great, great young guys. They're all going to be successful in whatever they do. And they're working on marketing. They're working on my LinkedIn. They're working on podcasting stuff.
Okay.
That's how you met Will. Will was checking you out and said, Joel, you got to meet Tim and get on this podcast. So I
Okay.
said, okay,
Excellent.
that's great. I love Phoenix. So, and then I watched you quite a bit over the last few days and saw how you interview. I think you do a great job.
Oh, thank
And
you.
um, so, and then the third guy is doing graphics and email, what we call drip campaign.
Sure.
So they're helping us find buildings, and they're helping us find tenants, and they're helping us find investors. And that's their summer job.
Awesome. Is that sort of like your big initiative for 2025 is to source more deals and to grow your sort of internship?
Yeah, we're gonna hopefully buy more deals and have more investors. The whole thing, it all goes together. One leads to the other.
Right. Okay. Excellent.
As you well know. Yeah.
Right. Okay. That's cool. Thanks, Joe.
Yeah.
I have a reflection question I like to ask some people is what do you wish you knew sooner about building wealth and success earlier in your career?
I wish I had known to take less risk.
So, um, yeah, back to that conservative approach, huh? Um,
Yeah. Yeah, it's a theme. It's a really important theme.
sure. How could you take less risk than what you're doing now?
I don't think
Then,
there's a way to take a lot of less risk other than doing debt-free deals. And we check our tenants' financial statements. We turned down a tenant today. We had a startup that looked at one of our buildings a while back, and we've been negotiating. We finally saw their financial statements, and they're not strong enough.
okay.
So
That's
one
really
way
important. Yes.
Yeah.
That's huge.
We have to be able to read the financials and understand their debt ratio and their revenues and their profitability, and all those kinds of things really matter to us, because if you put a tenant in a building who can't afford to pay the rent, it's a very bad outcome.
Yes, for sure.
Yeah.
For sure. Okay. That's a good one.
Yeah.
Yes. That's kind of funny though. I don't hear that very often. Most people say kind of the opposite. I wish I would have taken more risk. I wish I would have done more. Right. So it's funny that's cool, Joel. Thanks. I like that one.
Yeah.
Okay. So if people would like to connect with you and learn more about debt-free industrial investing, what should they do?
Our website is the best place to go. All of our current offerings are on the first page. It's Brit Properties, BRIT properties.com.
Okay.
And we have a number of different kinds of deals, different kinds of minimum investments and different sizes. We have a $13 million deal, and we have a $1.5 million deal. So they're up and down the gamut.
Okay. Excellent. All right. Very cool. Well, thank you everybody for listening and watching. Thank you very much, Joel Friedland, for joining me today. We very much appreciate you sharing your stories and your insights into leverage or not, and industrial and Chicago and Phoenix connections. Great stuff. Thanks, Joel.
Thank you, Tim.
Inspired by our guests? Visit phoenixprosperitypodcast.com/guest and join us on the show and share your success story with Tim. The spotlight awaits.